Welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because the global liquidity index finally made new highs. And although we know Bitcoin won't follow its path perfectly, it makes sense that a higher global liquidity index would be good for Bitcoin and other risk assets. And you can see that break into new highs here for the global liquidity index very clearly on this chart, completely undoing the downtrend we saw recently that was giving us major concerns that we could end up seeing an early cycle top for Bitcoin. But now that we've seen these new highs in the global liquidity index, my base case has to be that Bitcoin has higher to go into Q4 of this year. In this video, I really want to address the main counter argument I hear towards the global liquidity index, and that's that it can't be relied on because Bitcoin always has its cycle top before we see a top in the global liquidity index. But although this argument may seem logical on the surface, it completely ignores Bitcoin's journey over the past decade or so and how Bitcoin in 2025 is a completely different asset than what it was back in 2013. For one, today Bitcoin's market cap is over 2.3 trillion. And what do you think its market cap was back in 2013? Was it 1/10 that at 230 billion? It wasn't. Was it 1/100th of what it is today at 23 billion? Nope. It was just $13 billion in market cap, a very tiny asset in the grand scheme of things, and only about 12 million Bitcoin were in circulation at the time. And if we take a look at Bitcoin's issuance schedule, you can see that back in that cycle, the inflation rate was very high because the block rewards were huge at 50 Bitcoin per block and then dropping to 25 Bitcoin per block after the 2012 halving. So the Bitcoin miners had a huge impact on price and would sell Bitcoin very aggressively, especially after a 15,000% rally. So it makes sense that Bitcoin completely diverged from global liquidity and had its own crazy blow off top move where investors and Bitcoin miners started selling very aggressively. And back then, the price was mainly driven by drug dealers and tech enthusiasts and not macro investors and hedge funds like it is today. So it makes sense that it wouldn't be that correlated with global liquidity. And we see something very similar in 2017. Bitcoin had a roughly 100x move off the bottom. Investors and Bitcoin miners started taking huge profits because they saw their asset go up by 100 times. And the market cap at the time was only 320 billion, so not really a macro asset quite yet, and the circulating supply was only 16.7 million, so Bitcoin miners still had a huge impact on price because the block reward was 12.5 Bitcoin, and we were still seeing quite a bit of increase in the circulating supply each and every month because of that higher block reward. But interestingly enough, the gap between Bitcoin's cycle top and the top in the global liquidity index went from about 33 weeks in 2013 to about 15 weeks or 16 weeks in 2017, and then dropped once again to only 12 weeks in 2021, because for the first time in 2021, with all of the printing surrounding COVID-19, Bitcoin ended up becoming a macro asset and reached the global stage with a market cap of 1.2 trillion and a circulating supply of 18.8 million. So the miners had even less of an impact on price, and the price became a lot more driven by larger investors and long-term holders. So to me, it's very clear that Bitcoin is becoming quite correlated with the global liquidity index, whether we look at the timing between tops getting closer, or we look at how close the bottoms were between the global liquidity index and Bitcoin, or what Bitcoin did once the global liquidity index had its macro breakout back in April of this year when Bitcoin bottomed after the tariff drama. And this is exactly what you would expect from the 8th largest asset in the world, with a market cap of 2.3 trillion and things like the BlackRock and Fidelity ETFs, corporate treasuries, and some nation state adoption. Today, Bitcoin is a completely different asset to what it was in even 2021 and even more so in 2017 and 2013. And the impact of Bitcoin miners is becoming more and more negligible because the block rewards continue to shrink. And so much of the supply is already in the hands of long-term holders and larger players. And for those reasons, I don't think it's smart to write off the global liquidity index as a useless tool because it's missed the cycle tops previously, because it has been getting closer. And we see that with how well it has served us this cycle in terms of showing us the general trend that Bitcoin is having, operating with a bit of a lag. And if this pattern were to continue, maybe there's some volatility along the way, but I do expect higher prices for Bitcoin and other risk assets because of global liquidity rising and making new highs. So how am I positioning for this? I always try to maintain as much spot exposure as I can because I do expect assets like Bitcoin, Ethereum, and Solana to head higher. But the deeper we get into the cycle, the more cash I like to lock in and have on the sidelines. I did take some small profits on my Solana position this morning because it's up quite a bit over the past few months, but I'm trying to keep as much upside exposure as I can for the remainder of the cycle. If you're a little bit newer, maybe you need a smaller cash position. If you're just getting started and it's your first $100 in the market, you probably don't need a cash allocation at all. But depending on your risk tolerance and how deep you think we are into the cycle, I believe it makes sense to have some cushion on the sidelines so that you can remain calm and collected through the corrections and the FUD that we're destined to experience at some point. And as always, if you'd like to learn more about my portfolio automation system or mental models I use to navigate this market, or common mistakes I see so many investors making, you can check out the Crypto Enjoyers community and program in the video description. And we can't talk about the global liquidity index without talking about the US dollar, since the US dollar is the reserve currency of the globe. We are seeing a bit of a false breakdown here for the US dollar, which could lead to some short-term upside, but the macro trend of the dollar is down, and all we have to do is survive the volatility in between to see this macro trend play out. And the reason why the US dollar index continues to be weak and is expected to be weaker is because investors around the world are seeing the exponential debt growth the US government is taking on, and exponential debt growth results in exponential money supply growth as that debt gets monetized, which is now being discussed as the Fed's third mandate alongside the dual mandate that most investors are familiar with. And now this third Fed mandate really doesn't come up often because most people focus on their dual mandate of maximizing employment, aka keeping the unemployment rate low, and stable prices, aka keeping inflation low. And that's why on their economic projections that we receive every quarter, they prioritize talking about the unemployment rate and the inflation rate when forecasting their monetary policy. But right now we're in a very special situation that doesn't come up very often historically, and that's that the federal government is running these huge deficits. And when you have huge deficits and a very large debt now sitting at 37.5 trillion, all of a sudden the interest rate you're having to pay and the interest rates being set by the Fed and by the bond market become that much more important. Right now, for the fiscal year of 2025, ending, I believe, in October, you can see 22% of the US government spending is going towards Social Security, 14% is going towards Medicare, and in third place, we have net interest expense even above health or national defense, which makes it that much more important that the Fed keeps control of the bond market and doesn't let yields get out of control and make the interest that the federal government has to pay significantly higher. And now, how can the Fed keep the bond market under control when they only control short-term rates? They're expecting to do a rate cut in October and another 25 basis point rate cut in December. This is going to put downward pressure on short-term rates, but it's not going to impact long-term rates much. And really, the only way to have a large impact on long-term rates in terms of direct action is using yield curve control and increasing their balance sheet by eventually going back to QE and going back to buying back bonds to stop bond yields from getting too elevated. They have been doing quantitative tightening for quite a while now, which is reducing their balance sheet, and they haven't announced a stop to it quite yet. But I wouldn't be surprised if it stops sometime soon, because priority number one is the federal government being able to fund itself, that's more important than the labor market and inflation, because without the federal government being able to fund itself and keep up with its debts, you cannot maintain order in our current financial system. So although we can see short-term bounces in the US dollar index, the macro trend is headed in one direction in my opinion, and a weakening US dollar index means global liquidity is likely going to head higher on the macro timeframes, and all we have to do is try to survive the volatility we're going to experience along the way, which is why Monday's free weekly report was called Brace for Volatility. Whether it's an FOMC meeting or a surprising black swan event or a bad labor market print, you have to have a plan for these type of unexpected short-term scares if you're going to see this entire thesis play out. And the Fed has made it clear they're not exactly sure what the path of interest rates is going to be. They're going to take it meeting by meeting. So we will continue to keep an eye on labor market data like the unemployment rate, which continues to rise slowly and put more pressure on the Fed to cut rates. The good news is that we did see a cool off in initial jobless claims this week. So although it's slowly trending higher, we're not seeing a huge spike like you usually see going into a recession, but it's still making the Fed have to be a little bit cautious here. Although inflation is still stubborn around 3%, I think the Fed is being forced to prioritize other aspects of the economy, which is why we're watching them cut rates here, even though real GDP is 2% as of Q2 and expected to come in at around 3% for Q3 based on the Atlanta Fed's most recent estimates. And risk assets continue to price all of this in. We have the S&P 500 making new all-time highs, and I believe it's only a matter of time before Bitcoin follows because investors see the writing on the wall. So for me, I believe Bitcoin at the very least still has a final push into Q4. I will update this chart in time for the next video. Could we have the full reset scenario because something surprises the market and causes it to correct in the short term? Of course. But as long as you're focusing on spot holdings and not gambling your life savings on leverage, short-term pullbacks shouldn't be that big of a concern. And my main concern is being on the lookout for a major red flag like the cycle being over, but I don't see that quite yet. Market sentiment is still quite neutral, which is not what you expect to see at all going into cycle tops. Same thing with ETF inflows. Still relatively quiet, just small inflows coming in every day. We're not seeing any major spikes. TA looks pretty good with Bitcoin confirming that false breakdown below 112,000. So as long as we're above it, I don't even see any short-term warning signs quite yet. And we have some bullish narratives building up here. Now, I don't think anything major is going to come out of this strategic reserve discussion for the US, but the fact that investors have something to look forward to usually is good for price, kind of like a buy the rumor, sell the news event that this market loves to do. But it can be very easy to get caught up in narratives, so I like to focus on major support and resistance levels, major moving averages like the 20-week and 50-week, and looking at seasonality. So far, it's been a great September. Now, I'm not going to jump to any conclusions until the month closes because there's still plenty of time for some short-term scares. But as of right now, September is looking pretty solid, almost as though we had our September correction back in August. And it does look like this cycle is on track with previous cycles, just with diminishing returns, because as we covered previously, Bitcoin is a much larger asset now. So even though we have larger players like corporate treasuries and ETF buyers, they're also having to move a much larger market cap, which is why I don't expect us to see anywhere near the multiples of 2017 or 2021. But we'll see what happens. For now, in terms of our relationship with the 200-week moving average, Bitcoin is in the expensive region, in my opinion. This means it isn't a horrible time to buy, but you're not getting a great deal, and you have to be prepared for some volatility because we are deep into the cycle. But I do believe Bitcoin still has higher to go. And speaking of having higher to go, Ethereum continues to look solid here, consolidating between its all-time high at 4,800 and the range high that held it down for so long at 4,000. Any consolidation in this region, in my opinion, is just a pause before price discovery, and we just have to be patient enough to see it through. There's a lot of uncertainty right now surrounding the Ethereum unstaking queue, which has gone quote unquote parabolic with $12 billion in Ethereum waiting to unstake. We don't know if these are actually being unstaked to sell or just move into ETFs or who knows what. It could result in some short-term profit taking, but I do believe Ethereum's macro trend is still headed higher. We still have nice ETF inflows coming in on these spot ETFs, and corporate treasuries are still accumulating Ethereum slowly but surely. So I still believe we have higher to go. We also have Base, the most popular layer 2 on Ethereum, announcing a token, which should bring more excitement and usage to the chain. What we don't want to see is Base moving to their own chain and moving away from Ethereum. But as of right now, it seems like they're going to stay a layer 2, which is good for the underlying chain that Base is being run on, Ethereum. So to me, this continues to look like a bullish pause before Ethereum Bitcoin heads higher, similar to the bullish pause we had at the 50-week and 20-week moving averages as well. And anybody who's too focused on short-term price action and FUD is going to end up being shaken out the same way so many investors ended up panic selling their Ethereum when it was underperforming Bitcoin earlier this year. And speaking of no longer underperforming Bitcoin, we are continuing to see some signs of life here in the altcoin market. This continues to look like a mini alt season as of right now, similar to November 2024 and March of 2024. It's hard to know if we're going to have a 2021 style alt season quite yet, but it's no surprise that altcoins are doing well here with some solid narratives building up, like the SEC approving generic listing standards for crypto ETFs. So we could end up seeing a lot more ETFs than the market is currently expecting, which again could be a perfect buy the rumor, sell the news event, because I don't know how many inflows these ETFs are really going to receive. We also saw the SEC approve the first ever US multi-asset crypto ETP from Grayscale, the Grayscale Digital Large Cap Fund holding Bitcoin, Ethereum, XRP, Solana, and Cardano. We know how popular indexing is for stocks and other assets. So I'm really curious to see what the popularity of these multi-asset crypto ETFs that we'll eventually get will be, because that could bring some flows to these smaller projects for investors that want to diversify a bit from the major players. But in my opinion, there is still no better chart in this asset class than Solana. We've been bullish ever since the false breakdown back when we bought a little bit during the tariff drama. We were bullish when it had that reclaim. We were bullish when it broke above the range mid. We talked about the range high breaking recently, targeting the 2021 high. And if that breaks, we are headed to the all-time high. And right now, we probably have the best confluence of narratives for Solana that I have ever seen. We know the corporate treasuries are buying a ton of Solana, already accumulating $4 billion worth and about 3% of the supply, which is exactly what we talked about a few weeks ago. You can see here we have Forward Industries, DeFi Development Core, Upexi, I guess is how you'd pronounce that one. And Forward Industries is raising another $4 billion to buy more. Galaxy Digital continues to buy a ton of Solana. And we also have Solana breaking bullish on the super trend indicator on the weekly, something that has never given a false signal and has led to huge rallies in the past. Now, diminishing returns means this is likely not going to lead to a 600% rally like 2021, because Solana has a much bigger market cap now thanks to all the inflation. But I could see perhaps a 100% rally from here, or a 200% in the best case scenario. Anything above that would be icing on the cake. But Solana looks quite solid here from a price action perspective, and the on-chain activity is backing it up as well. Solana still has the most decentralized exchange volume, doing almost as much as Ethereum and Binance, the second and third place combined. And it's also second in terms of fees, getting very close to number one, which is Tron, and still above Ethereum in terms of fees generated. And it's getting CME futures in October alongside XRP, as well as spot ETFs. Again, this could also be a perfect buy the rumor, sell the news event, but we have to see if investors actually buy the rumor and see what price action looks like going into those launches. But the next month should be exciting for Solana and other altcoins. And because of all those bullish narratives, it's no surprise that Solana looks this good on its Bitcoin pair, closing above all major moving averages and reclaiming its range low. Next target would be the range mid, and then maybe even the range high after that. But I am targeting the range mid as of right now. And because of Solana's recent outperformance, we're getting very close to the trifecta we've been waiting for. Ethereum outperforming Bitcoin on a 1-year rolling basis, and Solana outperforming Bitcoin and Ethereum on a 1-year rolling basis. And I do expect that we see that very soon, as long as Bitcoin doesn't jump off a cliff in the next few days. But as we look forward, the federal government is still running huge deficits, getting very close to $2 trillion for fiscal year 2025 and 4% ahead of schedule compared to the last fiscal year. And this trend continues to worsen year after year And exponential debt growth means exponential money supply growth, which is bullish for our risk assets that we price in the fiat currency like the S&P 500, and especially bullish for fixed supply risk assets like Bitcoin. But as always, let me know what you expect. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.